Well, a very good morning, good evening, and good night to you wherever you may be listening to this podcast. My name is Mark. Thank you for tuning in. And I would like to begin this podcast with an article that came out today about the current state of the economy and the stock market, most notably. A lot of people had came out on Black Friday when the markets began to drop, labeling said drop as the beginning to the end, spreading a lot of fear, especially here on YouTube. So today an article came out confirming what we affirm and even predicted to a certain extent about the health of the capital markets. So, because of that drop, a lot of people started panicking and selling. And amongst those who started panicking was the YouTuber Graham Stefan. And I did predict and I did say that this massive drop that we had seen and we are continuing to see as of even today was mostly due by a big sell-off in the markets. So I will not be the one to categorize Graham Stefan as overreacting or over panicking. My understanding is that he has a relatively large portion of his net worth tied into the market. However, I did predict that it is too early to predict a stock market crash at the moment. So, in the article that we mentioned earlier, it has been stated that hedge funds are liquidating at the record pace because of their fear of the possible repercussions that the Omicron variant may have on the economy. Again, I do feel that it is too early to even mention a crash or a possible crash. And what a lot of you, especially the younger generation, doesn't realize is that these things are usually broadcasted after the facts. So, in other words, you will know about the crash after it happens or after it has begun to happen. Because, especially since there's so much liquidity in the markets, so it would be very hard. It would probably even be near impossible for somebody to be able to predict to the T when a crash will happen. And usually the circumstances that foment or create a crash are done in a series of events that creates a chain reaction, a snowball effect of sorts, over a reasonable period of time, usually accompanied by a lack of public confidence or lack of liquidity. All of the aforementioned and then some will have to come into play for that crash to happen. So, the US stock market is by far the most popular and most liquid stock market in the world. I am not saying that a crash is highly impossible. However, what I am saying is that we would probably need to have the perfect storm brewing in the economy first, a lack of confidence second, and everybody running towards the exits third, for us to even begin talking of a stock market crash. So now you may be asking yourself, so what do we have? So on one hand, we have this new variant that is assumed to be in the United States of America at the moment. I think many news reporters have came out to state that they've already confirmed maybe one or two cases. So now my question would be, how were they able to already determine that we have said variant in XYZ place? So again, it is too early to tell. So second, let me address the lack of confidence issue. I do believe that the United States of America remains by far the most attractive place for capital to be grown and invested. I am aware that yields have gotten squeezed for quite some time now, especially because of QE. So what I mean by that is that when you have an environment where money is cheap and it is readily available to everybody at said cheap cost, it becomes more challenging. And as a result of that, asset prices become more expensive. And last but not least, we do have the Federal Reserve, I believe, which is our lender of last resort. I can almost guarantee you that they will almost always step in the event of even a possible market crash. They have done it before, they will do it again because of the implications that are at risk. And also, the United States dollar is the world's reserve currency. And not doing so would, not stepping in would send massive shockwaves, not only into the US economy, but to the world's economy. So, our country's strength, financial strength, and might is heavily dependent on that. So all of the aforementioned reasons that I just gave you make me reluctant to call it a market crash. However, so if these sell-offs do continue, I do feel that it might trigger a chain reaction. As prices move down, stop losses will start getting filled, and because of that, prices will be driven even further down, which will cause higher volatility in the market, which will in turn trigger a lot of margin calls, which will create some type of temporary balance as we've seen today. So for those of you that have been market watching, markets have had a nice rebound. Again, that rebound was caused most probably because of the margin calls happening all at once. And if you're unaware, margin calls are essentially your broker telling you that, hey, for you to keep maintaining XYZ position, you need to come up with some liquidity, which will essentially serve as a cushion to weather the waves, so to speak. So this is not financial advice. I'm not telling anybody to get into any position or to even double down into your portfolio. So what I'm saying is that I do think we're a ways off from an actual crash. However, I do think that it is possible that we might see some significant sell-offs in the markets. And also be aware that we also have a lot of institutional money in the market, such as pension funds, sovereign wealth funds, and so on. So I don't think that a crash is a likely scenario at this point. We also did get word that the Federal Reserve will begin tapering. In layman's term, that simply means that they will reduce their output into the markets. In other words, they will stop or at least reduce the amount that they have been spending as of recently. Though substantial, I do think that the Fed's balance sheet is doing slightly a little better than we have all expected. After their many rounds of QE last year, I do believe that they were supposed to buy a lot of the corporate bonds out there. So their announcement had triggered a massive buy-off in the market. So because of that, the Fed was no longer obligated to make good on that promise. So and one more thing I want you guys to keep in mind is that today the jobs number came out, and apparently we're doing a lot better than we have, especially in the past recent years. A lot of people have gone back to work. Unemployment claims are down, and I think it is at a somewhat of a record for the last few years or so. Business creation is up. A lot more people are opening businesses and so on. So I do have a fairly positive outlook for the US economy overall. So I know that's not what a lot of you came on YouTube for. I know a lot of you would prefer the doom and gloom type of podcast where I tell you that it is the end of the world, that you should get prepared. But in reality, I mean, I do want most of you to have an open mind and to see things for what they are and not what you would want them to be. So the truth is that we're in a much better position than we've been these last few years. So I'm not entirely sure how long this is gonna last because of the said variant that has recently came about. But I do think it still goes without saying that investing is risky. You have to, in my opinion, only invest what you can afford to lose. And I know for a lot of you it's easier said than done, mostly because you've been trained to on a subconscious level, of course, to be wanting to get rich very quickly. And I think it is that Warren Buffett who said that nobody wants to get rich the slow way, everybody wants to make it fast. And Warren Buffett's strategy is actually the opposite of that. He focuses on growth stocks with high potential, with very little downside, with stocks that have very little downside with huge upside potential. And that strategy is usually what a lot of people refer to as value investing. It is a strategy in which, again, you analyze the fundamentals of the company that you're interested in, and if that stock is trading below of what it is supposed to, then I believe you'd go ahead and make a purchase in the hopes, of course, that it's gonna rise to the top. Now, a caveat to that is that capital markets also driven by supply and demand. So because a stock is undervalued, it doesn't necessarily signals that it will eventually go up in price. And the opposite is also true. If a stock is overvalued, it doesn't always mean that it's going to drop. As long as the demand remains high, you can temporarily defy the laws of gravity in the market. So now, be that as it may, being long a stock is probably the best way to do it, because when it comes to shorting a stock, it is oftentimes said that the markets can remain irrational more than you can remain liquid. So again, this is not financial advice. Please do check with your licensed professional. However, as I was saying earlier, it is imperative that a lot of you retrain your brain to avoid that getting rich quickly mentality, because if it is too good to be true, then it usually is. And also, most people that have found some form of success in the capital markets, they have done so usually over a long period of time. So a good strategy is usually with dividend investing or dividend reinvesting. So they would buy a stock that pays a quarterly dividend or so, and they would take the money that they get from those dividends and reinvest it into the stock, which will in turn grow their portfolio. And as they do it over a long period of time, their stake in the company grows, and so does their income. Again, this is not legal or financial advice. Please do check with your licensed representatives for that. So in the oil markets, we're getting worries that the Russians, they've made a proposal for OPEC to lift the oil output by 400,000 barrels a day. So what they're essentially saying is that they would want to increase the supply in oil. So as you know, the higher the supply, usually the lower the demand. and usually lower the demand and the higher the supply. So that announcement today actually triggered a massive sell-off in the oil markets. The WTI index dropped by more than 20%. So that is bad news for anybody invested in oil. However, it is good news for everybody that is buying gas at the pump. And we can all agree that having gas prices so high is a terrible way to run the economy. I mean, when you have high gas prices, it usually reflects in what you pay at the grocery stores. And what I mean by that is that your food are usually trucked in by truckers who are charged to bring these goods into markets and retail places. So if the truckers are feeling the pinch on these gas prices, they will usually pass these expenses to the consumer, because of course it costs them more to truck these products to you. So we've also reported that many states, like in California, for example, gas prices is selling north of $7. That is correct, $7 per gallon. And at $7 a gallon, there is not really much that these trucking companies can do to cushion or even to absorb some of the losses. So usually the most logical thing that they would do is to pass these expenses along to you, the consumer. And the direct consequence would be having to pay a lot more for what you buy on a regular basis. I mean, to give you a quick synopsis, many of you do not realize how important oil is to an economy. So it might seem seamless that in the morning you get up, you turn on your light, but many of you probably don't even know that a lot of these utility companies that is use oil to provide energy. So you take a shower, you use that hot water. It is also using mostly oil or some form of renewable. You get into your car, you drive to work. That is also consumption of oil. You get to work and around noon you go out to buy lunch. That food was probably trucked in. Again, more consumption of oil. So oil is probably more important than a lot of you even realize, as it has been made one of the cornerstone of modern day society. So I am not entirely yet sure what the end game is with the Russians. I'm not saying that there has to be one, but one thing is for certain is that many people will be enjoying these lower gas prices. So now Fed chairman has finally admitted that he will no longer use the word transitory to describe inflation. So what he's truly saying is that inflation has gotten out of hand so much that it is basically impossible to even put up a facade that at this point in time that inflation is transitory. So now it is not exactly clear that there were any mentions of raising interest rates, as this seems to be the sole, or at least the only solution that is being proposed by many economists. So now on the flip side to that, a few weeks ago the Treasury had released an inflation bond, I believe. So what it is exactly is that you can essentially go to the US Treasury to get that bond, and the return on it, I believe, is 7.5%. So my understanding of it was the Federal Reserve felt they felt kind of spooked about directly raising interest rates. So they used the backdoor approach to that by issuing these inflation bonds. So essentially raising interest rates without raising interest rates, if that makes sense. So I'm not here to criticize that move. of theirs, as I feel that this is a very good thing for economy, as it allows individuals and businesses alike to have that hedge, that protection against inflation, without the consequences that come with having to raise interest rates in the near future. So I know there's different school of thoughts on this one. So what do you guys think? Share your thoughts, guys, and let us know. And if you have anybody who can benefit from these bonds, like a parent or grandparent, family member, or friends, please do let them know. They can go to treasurydirect.gov to purchase these bonds and wait till maturity to pocket that extra money. So again, treasurydirect.gov. This is not a sponsorship. We're not getting paid for it. Just me relaying to you what is happening. Again, please do feel free to share this with anybody you may know. And again, this is a step in the right direction. So now my feeling is that if interest rates will have to rise, there is so much money that has been pumped into the economy. So I feel that it might have to be done gradually and at a very slow pace, because as much as low interest rates can stimulate the economy, and high interest rates can also do the opposite. So I feel that it would be in our best interest not to go to extremes, especially in a quick manner. I feel that this slow and steady pace will probably be a lot more beneficial to all of us, and especially with the boom in asset prices that we are now seeing. Raising interest rates at a rapid pace would probably obliterate the economy. And for those of you that do not remember, that's almost what we've seen in 2008 with the housing crash. So what had happened was a lot of these subprime loan products, they had initially a very low introductory rate. That introduction period ended, so the full amount came in due, and it was usually between 0 to 6 months based on the credit profile. So, and that created a massive bust in our economy. So again, I want you to educate yourselves and not follow the herd mentality in everything. To those that are crying out, stating that interest rates must be risen at a rapid pace, do not listen to these people. Do not believe them, because again, it would, again, remember, as low interest rates can boost up the economy, high interest rates can also do the opposite. So what you're looking for is essentially balance between the two. So this is not a channel for fear mongering. I'm not here to instill fear in anybody. However, again, it is important that you educate yourselves just to know the pros and cons of each monetary decision that we're making. So again, guys, treasurydirect.gov. Tell your family members, tell your friends, tell your neighbors, and let them know. So now today there was an announcement made by a major Wall Street firm announcing that Bitcoin-backed bonds that they are coming to Wall Street, and that firm was Goldman Sachs. I mean, Goldman Sachs is the Mac Daddy, the Ferrari of the financial services industry. And I believe that it is said that today they, as previously mentioned, they stated that a bond backed by Bitcoin is probably in the works. Not too much detail was provided after that, but I am pretty sure that my cryptocurrency guys are very excited as a result of that. And today, well, as of today's recording, Bitcoin is trading in the high 55 and low 56,000 ish area. So Bitcoin traded relatively sideways throughout the entire day today. So not too much action was experienced as a result of that. So I do see that this Bitcoin backed bond is a great thing for the cryptocurrency community. I see a lot of upsides to that. And I also see some problems that may arise. One of which is the high volatility that we have experienced in cryptocurrency, and not just Bitcoin, but I think it's pretty much standard across the crypto board. So these high prices and high volatility might be a deterrent to the accredited investors, because as we all know, in the US markets, bond prices and yields are pretty much inverted. As bond prices go up, the yields go down, and as yields go up, bond prices go down. So again, now the issue would be to find the right underwriting procedure, or to find the right people to implement the right strategy to avoid investors getting spooked out of the markets. Many of you might write this off as something that is unimportant. However, I do think that it is very important, because the inverse correlation can essentially make or break the product that is being offered. And I'm not saying anything negative about it. And again, as I said earlier, I do think that it is a great thing for the crypto community. Again, the implementation of the rules, the right rules that will fit or be a good fit for the average individual or investor, and the accredited investor as well, will be a big deciding factor for many people that might be interested in that product. So now, issue number 2, will the Bitcoin bond product that is being offered directly tied to the actual Bitcoin itself, or will it be a mirrored product of Bitcoin? So if that bond is essentially tied into the Bitcoin market, I think it might prove kind of difficult, especially in terms of liquidity. From my understanding, buying Bitcoin is quite a lengthy process. I am aware that a lot of stores have simplified that process in its entirety. So I believe they have made it in a way, they've made it in such a way that they've acquired the Bitcoins, and they have a pool of investment in which individuals can buy from. So let's say you go on a third party site, oftentimes you are not actually buying the real Bitcoin, so you're buying into that pool of funds. And I'm not saying it's a bad thing. I'm just saying that a lot of people don't realize that when this happens, you're not in actual possession of that Bitcoin. You are simply buying into somebody else's fund. So that is the downside to that. But the upside to it, which there is that, let's say you're dealing with a reputable service provider that is licensed and insured by FINRA. So I do feel that it gives you a hedge and some form of protection against, let's say, malpractice or negligence. So later on down the line, you might have some recourse if something was to go wrong. So I do think that the same principle would come into play. I think if it is Goldman Sachs that is creating their own pool of investments, it will certainly give that insurance policy and trust factor to the average and institutional investor, especially for the older crowd. I mean, your mom, dad, or grandma, they're not exactly, for the most part, exactly tech savvy. So let's say if grandma was to lose her Bitcoin um, key or password, she can't go down to the local Bitcoin branch and give ID and social security number to get her info back. Again, I'm not being negative about it. I'm just stating the realities of it. So knowing that grandma might feel disincentivized to actually invest in it, as opposed to knowing that she's buying into a stable and reputable financial institution like Goldman Sachs. I think a lot more people, especially the older generation, they would be more comfortable and be more trustful of the process. I mean, because let's face it, if anything were to happen, I mean, you have a number that you can call, you have a customer service line, you have an account number, and a whole trail of documentation and federal and state laws protecting your financial assets. So again, I think that Bitcoin backed bond or security is a great idea. And again, the implementation will either make it or break it. And I'm pretty sure Goldman, these guys are solid. Again, they're the Mac Daddy, the Cadillac of the financial sector. And that's not to take away from anybody else. I think there's a lot of them out there that have done a great job investing for the average Joe and institution alike. So I have no doubt in my mind that Goldman will probably find the right people and do a great job at doing what they intend to do. So again, it will come down to the implementation of that project. Now, the third issue that I feel that they might come across is the lack of regulations that currently surrounds the whole cryptocurrency market. I mean, again, I know we're in America, we're capitalists. We shy away from regulations, and I'm not saying it's a bad thing, but I'm saying when it comes to people's money, you would be surprised. I found out that they probably are almost always in favor of more regulations and added protections that will secure what they've worked hard for. So, I mean, as much as they'll tell you that, oh yeah, regulations are bad, it destroys the economy. I mean, to a certain degree, it does. I mean, over-regulation is certainly very destructive to the growth of any economy. This is why I said earlier that a fair balance is probably almost always the best thing that we should all strive for. But again, you would be surprised that a lot of these people, when it comes to their money, they would probably prefer that there are regulations in place and including insurance. I don't think that is something that is spoken much about. I mean, for those of you that have worked on Wall Street, that do work on Wall Street, or for those of you that have experience in the financial sector, I'm pretty sure you know exactly what I'm speaking of at the moment. It is almost always an easier sell when customer XYZ knows that you're regulated by FINRA, or you're FDIC insured, or you have a solid umbrella policy that protects you and your clients in the unlikely event that a financial tornado or some form of mismanagement, be it big or small, might happen. So a lot of you Wall Street guys out there, especially my Series 7 guys, or my Series 79 for the brokers, investment bankers, and so on, you do know that 99% of the time before you acquire somebody's business, they will probably go on that FINRA's website to do a broker check on you at the very least. So, and if for any reason you are not in good standing with FINRA, that is usually a deal breaker for so many of them. So again, this is not me judging or criticizing anybody. I do feel that this is the right thing to do, especially if you work hard for your money. So as a result of that, I do feel that Goldman might face some of these challenges that I've previously mentioned. Though these challenges are not too gargantuesque to overcome, but I do feel that they will be challenges and they will have to be dealt with. So it will be very interesting to see what the future holds for this financial product by Goldman. So what do you guys think? Please let us know in the comments below. I am looking forward to reading every single one of them. And as always, guys, this is not your typical financial channel. This is not a doom and glooms type of channel. We aim to speak of factual things and to educate ourselves and educate our listeners in the process. It is as much still of a learning process for me as it is for you. So please do keep that in mind.